capture properties over 25,000 feet. So our statistics are going to depart from Revista's numbers, but the trend is much the same. We see peak years at about $5 billion of sales, and last year was a record at $9 billion. This year, we're tracking a little bit below the first half of 2015. I'll point out that of the over $3 billion that was sold in the first half of 2016, 20% of that was in one transaction done by Dan. Physicians Realty Trust acquired the CHI portfolio, which was over $600 million, so a single transaction. So what I would comment on is I'd say I think going to still have an extremely strong year, probably not at $9 billion. These numbers do not include enterprise sales, so the current portfolios or enterprises that are up for sale are not included in these numbers. Ventas's acquisition of ARC is not included in these numbers, so these are just standalone asset sales. So we seem to be tracking at roughly maybe $6 billion, and I think we'll still be ahead of all prior years except for last year. Any comments you want to add to that? Okay. So starting to get into the juicy stuff in terms of who the buyers are, there's been a common thesis that private equity has substantially increased, and on the surface, you'd see that in 2015 they were the lead buyer group. And they're tracking year over year as well. If you look down, we've broken apart the REITs between the non-traded REITs. At the bottom, the big three diversified REITs, and then the third category down are the pure play medical office REITs, which are, I call them the big three MOB REITs, which are Physicians Realty Trust, HTA, and Healthcare Realty. Some commentary in here, I would say private equity, and it's an important theme that was brought up in this morning's panel. It's a very diverse group. It consists of groups like Harrison Street Real Estate Capital, MB Real Estate, with both core funds and closed-end value-add funds. It includes some legacy, institutional investment managers like LaSalle, Heitman, Bentall, and it includes smaller private equity groups. So it's a very different group, and we'll talk about that a little bit more. So the private equity has grown, but they're not all of the same ilk. Importantly, I think you can certainly see that the MOB REITs have been a voracious acquirer of properties. Of the about $1.4 billion of acquisitions by the big three MOB REITs, about half of that 2016 first half volume is the CHI transaction. The rest of it is obviously more granular, but those public MOB REITs have been in that virtuous cycle that Peter Scott has described, where they're at pricing perfection in terms of their cost of capital and access to capital. And just one little comment on the last category of the diversified healthcare REITs. Of that $1 billion that they did in 2015, full 2/3 of that was consumed in two transactions by Welltower, Dan's legacy, and HCP. So they've been a little bit of a smaller buyer, and that was just kind of an oddity of timing. Dan, you're going to talk about this information.
Thanks, Mindy. What's interesting on this slide to me is following up on Peter Scott's comments this morning, which were spot on in my opinion. You've got the six public REITs here between the kind of stratification that Mindy talked about between the pure play and the diversified, but you have them all here. And that's $25 billion or so together in total investments in a space that is just an incredible multiple of that. And what surprises me a lot continually is that these numbers aren't bigger, and I think over time they will get bigger, and we'll continue to see more investment as the systems and the investment community starts to trade more in these assets. And so I think we'll see that. You can see that maybe some of the firms with a bit longer of a head start have bigger portfolios, but it's all a pretty tight band when you consider it between $2, $3, $4, $5 billion. So there's competition among and between this group, but this is just the public piece, and you look at the private piece, and that adds a different element, as Mark will attest to in a few minutes. But it's I think you're going to continue to see, without some kind of cataclysmic external event happening, you're going to continue to see investment from the six of these folks into the space.
And to your point, I think if you had looked at this chart 2 years ago, the three on the right would have been even smaller. And if you consider that the three MOB REITs probably have bought about 15 to 20% of everything on the market in the last year or two, that will continue to grow, I believe. This table just is kind of an interesting point about where we're at with the scale of medical office. A few items to point out are, and this captures the 10 largest individual properties that were sold, and over the last 6 years, including year to date. There's been no medical office building sold for more than $200 million still. And you contrast that to other sectors. I don't know if you're buying other things, Mark, in other segments that exceed that, even in spite of the fact that you're in a niche business. But
no, I think student housing is the only one that would come close to that, and the largest deals there are in the 100 to $150 range.
So of this, the few interesting points that I see here is that the scale of medical buildings is getting larger. If you consider the average that Revista reports is 40,000 square feet, and over this 5-year period of the largest properties, the average building size has gone from 100,000 to 250,000 square feet of the top 10 largest that have sold, and the median sale price has gone from $38 million to $109 million. And I'm missing, it's not showing on this screen, but the median has kind of moved into the middle of those bars. What we really had from 2011 and 2014 was one big property that skewed all of the data. And in 2015, there were a lot of very large sales. So I would expect that trend to continue, and that's consistent with what's happening with some large outpatient health center development. So regarding just what's going on in the marketplace in terms of investors, and I'll ask Mark and Dan to chime in, we've had two recent it's growing. There's a lot more interest and more investors coming into the healthcare space for the reasons that have been cited this morning. We're kind of entering that defensive stage, preservation of capital, interest in the yield here, which we'll get into a little bit more. There were 2 IPOs of REITs in the last 3 months. Global Medical REIT went public in June, and MedEquities went public on Friday. So they're small by comparison, probably more similar to Physicians Realty Trust when it first launched. They may aspire to catch up to you, Dan, but
aspiring's good.
there's that. There are what I call serial sponsors. Mark, you're one of them. You maybe could talk about your next value add fund, your add-on to your core fund.
Sure.
Just to scale.
Yeah, just to give you a sense of what Harrison Street does. We invest in education, healthcare, and storage-themed real estate, and we have a couple different buckets of money. As Mindy mentioned, we have our value add or opportunistic fund, which is raising about $1 billion. It'll have its final close probably at the end of this year or early part of next year. Same three themes as I mentioned, and certainly heavy in the healthcare space, and within that is the medical asset class. We also have our open-ended core fund, which competes, I think, more competitively with a lot of the REITs in the room here. And that vehicle itself is about $3 billion in terms of total cap, and is likely raising, call it, $800 to $1 billion a year. It's the same three themes. The leverage is similar to what REITs do, and the cost of capital is similar to the REIT structure as well. So it's a private answer to, I would say, where the public REITs are going after, where our investors are more pension funds and endowments, and want a little bit different of a vehicle than if they're going to go the public route.
So an important point is there are some, you're a serial sponsor. You're continuing to add regular stable of investors. There are other serial sponsors, which would include a couple of the non-listed REIT groups, Griffin American and CNL, both have relatively new REITs that have been formed and are now investing. So a lot of familiar faces, but I'd say there's also new faces, and that consists of some new closed-end fund sponsors who have never been in healthcare in the past. I won't name names, but they're there. And there are also many new separate account investors. So the investment managers have been successful in attracting new investors into the healthcare space, and it's both domestic and foreign capital. Many of the names have not been identified out there in the public sphere, but these investors, the investment managers, are known to have acquired certain properties, and it's not always known who those separate accounts are. So I think, in my trade, I'm seeing a lot. I'm seeing a number of new investors coming in. Whether they will make this a staple of theirs, I don't know. You're competing against them in other places, and
I think it's great in the long run. I kind of look at this as a short run, long run analysis. In the short run, nobody likes to compete. We'd love to win everything ourselves. But in the long run, it increases the sophistication of the space. We're seeing, barring a golf analogy, there's horses for courses. There are the strategies are now starting to separate. You can see differences between different strategies for the investment community, and I think that's a good thing. You've got probably multiple enhancement that occurs over time because of the influx of more capital into the space. Revista exists for one of these reasons to help with that aspect of it. So I think long term it's a very good thing for all of us in this room. And short term, you compete hard and you try to win the deals you can win.
I would agree with Dan. I think it's absolutely a good thing. I think the hard part about it is, you mentioned there's a lot of these folks trying to come into the space, but for everyone that is doing a deal, there's probably 5 or 6 that have said that they want to get in but haven't been able to figure it out. And so I do agree that there's a lot more people coming in, but a lot of them just can't get into it because they don't want to do $10, $15, $20 million deals. If they can find a $200 or $300 million deal, or even $100, they'll do it. But it's hard for them to dip their toe in the water for a $15 million deal and really educate themselves and spend the amount of time on that versus doing a $100 or $200 million office building. So we've talked to a number of different investors that are trying to get in, but they want to put out $200 or $300 million. And I know a lot of these separate accounts and other investment managers besides Harrison Street are doing it. They haven't been as successful as I think that they've said that they will be to that separate account. And so it remains to be seen if those separate accounts or those investors will find a different avenue into healthcare. They're clearly committed to it, but will they go invest in REITs or will they invest in funds? And I think that'll play out over the next couple of years.
Yeah. And a point that Chris Merrill brought up in the panel this morning, Mark, was that there is a significant amount of new capital coming in that are long-term holders. So you might consider this private equity, but the complexion is changing from closed-end funds to open-end funds and separate accounts with long-term holders like the REITs. So how would you add on to that?
I would say the majority of the new money coming in on the private side, and that's coming into more of the healthcare sectors or the niche sectors are long-term holders, and they have the cost of capital that's very similar to REITs, and some of them, the sovereign wealths, may have lower cost of capital that may be buying some of the stuff that people sort of scratch their heads at, but they have a different viewpoint of the world and can accept a lower yield. So most of the money coming into the space on the private side, even though it may be deemed private equity, it is looking for a longer term hold, whether it's 7 years, 10 years, or 15 or 20. It's certainly, they like the space, they like the exposure, where the demographics are going, and so it's just a different vehicle to invest in the space.
Great. Eric, do you want to comment on loan volume?
Sure. Our loan volume has been relatively strong in years past. I think Mindy called me an 800-pound gorilla, which is unkind, no more than 350. We've tracked at, 750 million to a little over $1 billion a year for the last 5. This year has been much more than that. We'll probably double it. And, there's really 2 factors that are influencing it. One, in a significant but smaller way, is the pure play MOB REITs. We do a fair bit of business with them, most notably Doc REIT, who has a pretty strong presence in the at this particular event. Good work, gentlemen. And then, in a larger way, it really correlates with the change in the makeup of the MOB buyers to the private side. So the more private buyers and private equity buyers, the more finance that's out there, and the more that we finance. So it's correlated very nicely with the change in the MOB buyers over the landscape of the last year.
Thanks, Eric, and we'll get you to talk some more about the loan market. We're going to talk about pricing, the fun stuff. And Mark and Dan are going to go through some of these slides and metrics in their own way. And I'll give you the...
No, Mark's going to go over each one of these box by box. You guys got a couple hours to dig through this?
Who wants this? Or you want to just speak to it? So
go ahead, Mark.
Cap rates have come down. I mean, it's clearly from 14 to 16. Part of it is the amount of capital coming into it, into the space, and I think the other part of it, there's a dearth of product for that capital, and so clearly people are reaching for yield, and they see healthcare as an excellent investment for what they're trying to get done.
They're coming down, and I'll submit this for discussion. I kind of feel like there's more predictability, though, and I don't know if I want to use the word stabilized, but I feel like our ability to predict where a certain deal is going to either come out at or trade at, there seems to be, maybe because of the volume of the trades that have happened over the last couple of years, there just seems to be more statistical, the predictability there is greater, and I think it's easier to see for us.
The only thing I would add to this is sort of a broad general view. The A stuff continues to be very price competitive. The B stuff, which I thought was mispriced probably the last year or two, you've seen, or at least we think we've seen sort of a widening between that and the A stuff, and I think that's probably more appropriate now. And I think that you're probably going to have an expansion for the B stuff, versus where the A stuff is trading. It's all relative, but the spread between A and B, to me, has widened, and which is appropriate where the fundamentals are.
I think that's a good point. I always get a little unnerved by the aggregate roll-up slides because you've got 5 cap deals in here and you've got 7.5 cap deals in here, and it's a little misleading. We can spot the trend, but
yeah. Well, Hilda Martin had a great slide in the opening session, really picking apart that point that the highest quality Class A product, she was distinguishing the yield compression there, and I would suggest that there really are only a small number, 10, 12 of what I would consider the highest quality, most core properties that sell. You can name all the deals that are out there that are getting those low cap rates. They tend to be in the big coastal cities. But I'd ask you, what are the lowest cap rates that you've seen on deals in the last, 6 to 10 months?
You're looking at
Yeah,
4.6.
yeah. We like to compete, but you won't see us showing up for 4.6, I don't think.
Yeah, but in that, where would you bracket the most competitive, what is that most competitive range that those most core or the largest deals have sold at?
I think, taking out a few of the outliers, you're 5.5 to 6 in terms of core buyers for, whether it's REITs. And I think the other stuff, the people that are buying those, and not to say that they're not great deals or won't turn out to be great deals, but I think those guys are comparing, the buyers may be comparing it more to general office, and the cap rates, we're still getting a spread. I mean, I'm looking at the 4.6, and I think that's probably 50 basis points, if I'm right about the deals, 50 basis points wide of where CBD office was trading in that particular market, and so they were still getting a premium to CBD office. So relatively, they may think that that's a good buy, and it will likely turn out to be.
Yeah, I would agree with that range. We have to peel out, we would peel out California and Eastern California, i.e. Boston. If you take Boston and California, take them out. Maybe Seattle. I think we're in the range Mark was talking about. The others are going to have a premium.
And if I can ask you a question, Mark, about I'll call it the Class B or the Core Plus value add product that is, call it 87, 90% leased. How do you believe the market is pricing that deal? Just the pricing discipline around it. It's not what the number is, but how are they looking at in-place income versus projected income? How do you believe investors are underwriting today?
So the 87 to 90, I think those could actually be core deals. So there's a lot of nuances that I think if you drop below that and it's maybe it's older product and you're forecasting some sort of a lease up. To me, the cap rate that you're buying into matters, but not really. It's all what you can stabilize it to. And so every buyer that we would compete with, or that I would think would be saying, okay, if I can buy it for a 6, but I can stabilize it to a 7.5, that's where I'm going to make my money. Before, I felt like people were pricing some of that into the deal itself just to get product, and they were also assuming that they were going to get lease up. In talking with people, and this is purely anecdotal, I don't know that everyone is underwriting a lease up to 95% for those assets, and so that's probably contributing to the lower pricing for the B quality. And some assets could be functionally obsolete, or there's going to take more TLC to get them up to a more stabilized level. And stabilized may be 90%, which isn't a bad thing. It depends on the market. So I think it all depends on the age of the building and the market that you're going into. But if we're buying something at a low cap rate that's not sort of trophy class A, it's all what we can stabilize the asset to. It doesn't matter what we're buying it at.
Are the lenders having some influence on the pricing that way, just in terms of what the expectations are about lease up or other attributes of the property, remaining lease term? Do you get that feeling?
I haven't had any issue with getting good debt. I mean, we're not going out there and getting 75 or to 85% debt. If we're doing something like that and trying to get more of a value add strategy, we're hitting that 60 to 70% mark. The lenders that we deal with, like Eric here, has been phenomenal. They know the space well, and so assets that we're looking at, I think they believe in our business plan as well, and so we haven't had one issue trying to get debt for that. You got to go with a lender that knows medical office, though. So I think that's the key thing.
You're sitting next to
which
him,
is
right?
why Eric does 50% of the market share right now.
With a lot of controversy about on versus off, we have this, what appears to be emerging trend here. A lot of questions about what is an off-campus building and the complexion. So I'll let the two of you comment on that.
Yeah, this might be an outlier opinion. I just think it means less now. I mean, we've looked at great off-campus buildings and great on-campus buildings, and similarly, we've looked at crappy on-campus and crappy off. It's more about other factors, the market, the system, or the physician group, the competition, the economics. So this is a factor, certainly not to be ignored, but it seems like a few years ago this was maybe the factor, and for us it's just one in the mix.
I would agree that it's certainly not the first thing we bring up when we talk about an opportunity. Obviously the health system, the market, whether it's on or off, you can have good or bad. So, the only time I really talk about on and off campus is when we're talking with a new investor that doesn't know exactly what medical office is, and then we start with on and off campus. But it's not as big a determination if we like the asset or not.
I mean, are we maybe missing the point altogether and discerning between on and off? Should we be talking about the health system, what's in the building, forget the location, and do you start thinking about your investments that way?
That's our number one, is what health system is in there and how strategic is that building for them. So,
And what drives that, how strategic it is for them?
a number of different things, the market, how much money that they put in, what are they doing in that building, could they replicate it somewhere else? I mean, there's a number of reasons why, how well they're doing in that space, what are they actually doing in that space, do they have a good referral pattern, if there are other tenants within that building. So you could go down the list, and certainly these guys could talk about it more than I could.
Well said.
Okay. Does the size of the building matter to you? Or how does size factor into it?
Size always matters at times, right? I think that if you have a 20,000 square foot deal, well, it can be fine, but we're probably not that interested in it just because of the dollar figure. If it's part of a larger portfolio, then maybe. But it would be great to have a 100,000 square foot medical office building, or 150 if you have a health system that is committed to that space. The reality is there's not a lot of those out there. So the bigger the better, usually, I guess, if you're going to use generalities. But our average size is probably 45,000 square feet. So it's not. We don't have a ton of 200,000 square foot deals that are there. There's probably more coming along as more health systems develop these assets. But again, our average size is 45 to 50,000 square feet.
I think a stat that I use is the Revista 40,000 square foot average building, but what I would consider the institutional owners, which are the REITs and some of the other large holders, the average building size is 65,000 feet. So the inference is certainly you're going to have a lot more in that building. It may or may not have that intensive infrastructure, but you're going to have primary care specialists. You might have a surgery center. You might have imaging and lab and pharmacy. You can, if it's bigger, you're going to have more stuff in it, and it's going to be more critical infrastructure, right?
Clearly, not only to how strategic that building is to it, and the health system is, we continue to likely move towards population health. They can do everything in that facility.
Yeah. So sort of lending credence to the point about maybe it's not on versus off. Mm-hmm. Mark's going to go through every one of these bars again.
Sure.
Prices are going up.
Yes, see me at lunch.
Just a quick note on that prior slide.
Okay.
We watch this, maybe, when we watch this, it's something to look at. Especially in lower barrier to entry markets, this is important where you don't want to find yourself out ahead of that per square foot cost and risk somebody jumping down the street and doing something else. So this might mean a little less in a larger core market than one that's easier to do something in.
Mark, we're going to let you talk about medical office versus other commercial property investment.
Sure, and
I'm going to let you use
I'm not going to spend a ton of time on this because I think a lot of people in this room know. Medical office, at least for us and what we talk with our investors, it's a relative value. And as I noted, we invest in education, healthcare, and storage theme real estate, and so we compare each of our niche sector to a traditional office or a traditional real estate class. And so within medical office, we compare a lot to general office, especially when we're first discussing the investment with a new investor that doesn't know a lot about medical. You can still get, and I'm going to go, I think this slide tells a little bit, but the next, this slide to me is the one that speaks quite a bit about the fundamentals of medical versus, say, CBD office or suburban office. And again, these are all generalities, but a lot of these, both the CBD and the suburban, are in core funds that are compared against, I would say, core medical office buildings. And so right off the bat, you can get about 150 basis points on your going-in cap rate for medical right now versus CBD. And even 85 on suburban, and move all the way down to the right side of that chart, and you have a 2.2 implied cash on cash versus almost a 5% for medical office. And that's what we're really telling our investors is you have to get, for them to come up and get the same return, you have to have enormous amount of growth in their rental rates and in their NOI to just get back to where we already are. Now the counter is that medical office, you don't see a lot of huge rental spikes that you do in office. But where we are in the current environment, we're seeing a lot more investor interest because of that number, that 484 number, where the implied cash on cash. And our portfolio is a little bit different than this, but I think it just illustrates the point of, fundamentally, we feel that medical office is a better investment than both CBD and suburban, but it's not being priced like that right now. And so there is probably room for medical to grow or CBD suburban office to at least come up a little bit to get closer to where we believe the long-term fundamentals are. Again, this just illustrates the point here. Their occupancy at 89 and at medical at 92. You look at the remaining lease term at almost 9 for medical office. And this is, again, just generalities. But if you covered up the left side and didn't know which asset class we were, I think everyone would choose medical office. And so that's why I think you're seeing a lot more interest in the space, which I'm sure everyone here is very much aware. But this, I think, fully illustrates it.
Rents can't go down that much, too. But
rents can always go down, but
relative to the CBD office.
Relative to the CBD office, it's a lot less volatile. We don't have the slide on here before, but during the downturn, which I think a lot of people a lot of investors are certainly looking at, what happens, when the shoe drops. Medical office rents, from what we have seen in our research, went down about half what CBD and suburban office did. Now they didn't go up as much either, but sort of that the lack of volatility, I think, is what's bringing people to the space.
And along the same lines, we have an illustration of healthcare against different property classes. This is NAREIT data showing total return for those different REIT sectors. I like to call out the dividend yield on the right. That's a really simple, stupid way to, as a proxy against for yield for investors that are just yield buyers, where you're getting around 200 basis point benefit for the healthcare sector overall compared to the traditional food groups. Healthcare has outperformed this year, and prior to 2 years ago, it had outperformed all sectors coming out of the recession. This slide doesn't really capture that adequately, although it's performed nicely against over 5 years. And healthcare REITs had outperformed and outraised capital for 7 years coming out of the downturn. So really testimony to the strength of healthcare for investors. Eric, we're going to have you talk about the debt market, and I'm going to give you the remote.
All right. So the debt market, excuse me. On the current market, the current environment, there is a fair bit of discussion this morning at the initial session on the debt market today. No news to anybody. Historically, rates are low comparatively to where they were before. There's a fair bit of money in the market. There are folks that are willing to do mezz. So, it's a pretty decent market these days for the private investor. And they are to some degree taking advantage of that. Again, looking at the MOB transactions and who the buyers are. So the lenders out there include, the commercial finance companies. I'm not sure there's many of them left. I was at GE, no longer. So we went from being completely unregulated to quasi-regulated to now a bank. So most folks you'll see will be banks, life companies. There is some CMBS out there. I don't know. I haven't heard of anyone doing it in medical in a while, but it is theoretically possible. And then there's kind of alternate lending classes with, debt funds. Some REITs will do some debt, things like that matter. When you look at the lending terms by lender type, the flexible, typical MOB type debt you'll see are usually from the bank groups. The longer term, relatively inflexible, although I don't work for one, so don't blame me, is what more you'd see around a life company or a CMBS execution. And then for the alternate lenders, it's kind of everybody in the pool. The REIT borrowing capacity, I don't know a whole lot about. We work with REITs. We're in lines. We're happy to do secured debt for them, whatever they're looking for, but that's not really my area of expertise, so I'll punt on that one. U.S. debt outstanding by lender type. Again, the vast majority is bank. Compared to everything else, I think medical office would probably look very similar. When you look at the current mortgage debt conditions, so life companies, focused on high quality. I mean, you guys can read this. Life companies are typically longer term, a little more inflexible. If you don't plan on utilizing the capital markets, if you don't plan on selling or recapitalizing your asset for a relatively decent period of time, that may be a good option. Their leverage typically stays relatively low at 50 to 65%. When you look at banks, which is what we are, the key things for banks are, flexibility. Are they able to provide TILC fundings? Are they able to do releases on portfolio transactions? Are questions to ask. The regulatory environment we are somewhat new to, coming from GE, but Capital One certainly is not. Executing for the customer is our biggest thing. You always have customers, you have internal processes. Now we have depositors and regulators. To date, that's been no issue for us executing for the customers, but that is out there. Willing to go a bit longer term is typically what banks do, 5 to 7 year financing. We'll go up to 10 on certain conditions. And then construction debt, we are getting into construction debt as some folks are getting out of it. So we plan on rolling that out in the first quarter of next year. And just anecdotally, we've heard that construction debt's a little tighter these days, but with not being in the business yet, I don't know. CMBS, longer term option similar to life companies. The market moves around a fair bit in terms of spreads. Again, if you want to lock up your asset for a relatively decent period of time, don't want to sell or recapitalize, could be a good option. Agency lending, I have not seen with respect to medical office. That's more on the senior side. Mark would know about that. And then alternative, I think the key takeaway from the alternative lenders is really the mezz financing. So you are able to go up past where we typically go. So we max out leverage at probably 75%. Being a bank, we're happy to if folks want to use mezz that we can play nice with up to 85%. Depending on the product and the asset type, we're okay looking at that. So we are okay with mezz behind us, and there's mezz out there to the extent folks want to kind of maximize their leverage. The mezzanine debt's also an interesting discussion if you want lower senior secured. So if you want the 50 to 65% senior secured first mortgage, and then layer on mezzanine debt up to a more typical 75, folks have gone that route too. It really depends kind of on your business plan and how the rates shake out. When you look through the lending parameters, banks, again, 3 to 7 years. Usually, we are kind of an oddball in this one. We're happy to go to 75%, so we'll do a little more leverage than this. We'll do a little lower debt yields. We're just better. Our pricing is relatively in line with that, and we will do 10-year debt on occasion. Lifeco, you're seeing a very similar thing. They like similar to what I said before. They like the 10-year. There's a lot more data in those buckets. Same with CMBS, and then agency probably not really a factor for medical office. And then CMBS, I don't know, Mindy, you want to talk to that one? I don't know it quite as well.
It's out there showing us less of a factor these days. And we actually did do a CMBS deal for a portfolio of medical buildings in this past year. So it has a place, where you've got some idiosyncratic, situations with buildings. There's, this is an alternative source of loan money.
I would say we're buying a deal right now that has CMBS, and it's awful. So hopefully you guys don't want to do that.
Well, as you can see, the maturities, since historically they were 10-year deals, and you look at the peak year of issuance in 2007, so we've got the last big wave of maturities in 2017. CMBS was never a favored outlet for, the most prominent, but there are quite a few MOBs with CMBS debt on them. We're selling one right now, but they're getting to that tail end, so there's not a lot of time to maturity. So less and less of a factor, but it is, sure. There are risk-based rules kicking into effect at the end of this year that are going to require underwriters of this product to hold it on their balance sheet. So that is, we're expecting a pricing kink in that market so the cost of that capital is going to go up, but there is a place they will underwrite some assets that are more challenging in the rest of the market.
Okay, and then underwriting challenges. So this is a good slide. These are some of the things that come up when you preview a building, when you send it to lender, what they're looking for. So occupancy is a pretty big one. For us, we are happy to do value add deals, but our occupancy probably bottoms out about 65 or 70. Below that, it just gets very difficult. I think that would be, I'd ask the investors here on the panel, but that's about where your positive net cash flow, I think, in that 65 to 70% occupancy range. So we'll do anything from that and up. If it's below that, I'm sure there's alternate debt out there to find, and you can probably cobble together some sort of bridge until it gets to a level where you get more institutional finance. With tenant roll is always a very big one. As you buy second, third generation buildings, a lot of times you'll see a lot of roll in individual years because folks signed up 10-year leases and they extended 10-year leases. There are ways to mitigate around that. That's the primary theme, I guess, of the lending would be to work with someone who knows what they're doing. With respect to the tenant roll, you can mitigate that, in several ways, right? Some of it's just location. If you're on campus attached to a hospital, pretty mitigable roll, right? I mean, it's unlikely they leave if they're attached. You can mitigate it via loan controls. You can have debt yield tests. You can have hyperamerization. You can do spring guarantees. There's a lot of things you can do with individual tenant roll. When you look at lease terms, short extension terms, that's more of a, for the lender, that's probably more of a asset management deal where, if indeed your loan's on our books and you want to do a short-term extension, I don't know that we necessarily have a problem with it, but that's probably more on a case-by-case basis. If you look at overall lease term, we look at it more on a year-over-year basis. So, we look at it as provided this is the case that they're all separate incidences. And, to the extent it's below, say, 20-25% on a year-over-year basis, we're probably okay with that. When investment committee says, well, there's 150% rolling over 5 years, well, there's not, there's not much in each individual year, so we're probably okay with that. Location clearly is very important. When we kind of go through the things that we look for, sponsors typically number one, right? We're a sponsor relationship organization. We got a few in here: Harrison Street, Doc Reed, MB Real Estate, especially is in the room, and we want to do deal over deal with folks that are Anchor Health here, deal over deal with folks that are doing MOB deals. So sponsors first, and location's probably a really tight second. We're very interested in the location. Some of the things Mark mentioned, how strategic the asset is to the hospital or physician group, what type of medical property or medical MOB is it, and then with location, our thing is really that: is there a reason for the docs and or the health system to be in the space? Is there a compelling reason for them to do it? Hopefully, if somebody we like to lend to is buying it, there definitely is. But that's really what we kind of look for with respect to location. On or off campus, we are pretty ambivalent around. I think Dan said it very nicely that you see good ones and bad ones in both cases. Some execution risk is probably eliminated if you're on campus attached and the hospital's doing well. But other than that, we're perfectly happy going on, off, kind of wherever. And then we do a little bit in the life science space as well.
How are we doing on time? I want to make sure we have time for questions and whatnot.
8 minutes.
Okay, we'll go fast. Did we skip a slide?
Yeah,
Go back one. Quick point on this one. You've got all the publicly traded healthcare REITs trading in a pretty narrow band of 26 to 38% leverage. I think that's indicative of what the investment community in the street says is the right kind of leverage. So plenty of fresh powder there, I think, for future acquisitions. Yeah, thanks. Not much to spend here. I just wanted to show you what the lines of credit looked like in terms of total and available or used up for the publicly traded REITs. You see it there. This is a snapshot as of 6/30. It's a lot different today in some of these cases. So this is something that's interesting, but maybe not worth spending our last 7 minutes on.
Point made in the panel this morning. The REITs are accessing debt capital under 4%, equity capital under 5%. Very compelling buyers, especially companies like yours. So that's an important point.
Yes.
Market. Want to do this? or should I do this quickly?
You can take that.
Okay. Just going to touch on monetization. As Hilda Martin said in the opening session this morning, we have 57% of the outpatient property that is still owned by the health systems and another 25% owned by providers. So not enough high-quality product to buy in the market. We'd love to unlock that. And these are 4 notable transactions done in the last 2 years. It really sums up. There are four mentionable monetizations done in the last 2 years. So it's not a lot, in total. The CHI deal was really the biggest one ever done, but you're looking at, $1 billion in the last 2 years when there's been, 15 billion of sales or more. Point that I make is, as much as we like to unlock it, there's, over a 10-year period, this is the total of monetizations that have been done of scale, and it represents less than 5% of the total sales volume over the 10-year period. So we've got to do a lot more. I'm kind of sanguine about this happening anytime soon in any scale because the hospitals have great access to capital right now, too. They're also financially strong today with, by and large, good cash flow. If you look at who monetized, they had
Thanks for the cheery news, by the way. It's great.
Each of these had very strategic reasons for monetizing, mostly related to growth, balance sheet, the right reasons, I think. I think there will be more of those needs in the future, particularly as certain systems as consolidate, and not necessarily a bad thing. Memorial Hermann's a great example of just a high growth system, needs a lot of access to capital, diversifying its sources of capital, and I think we'll see more of that as there's more consolidation occurring with accountable care.
I can answer any HOPD questions afterwards. I'll give you the 10 seconds because I really want to allow time for questions. If you own an HOPD grandfathered asset, you're in good shape. Going to be a pretty sticky asset. And if you are looking at acquiring one or a provider is looking at doing one, it depends going forward. There's a lot of reasons on both sides of that argument. So I'm happy to answer later, but let's get on to questions.
Okay. So we're happy to have the audience fire away. James. Yes. The point is, the point is CMBS is a niche, and here or there you may have a property where the best execution is going to be there. It might be short remaining term or some other idiosyncrasy of the deal. It's not a very active source of capital, so I wouldn't worry about it. John?
Yes, you touched on the health systems and they're holding on to many of those properties. Barring any big monetizations, where do you see supply coming from? I mean, we talk about all the great ways that, all the benefits of owning medical office, but how about 2-3 years down the line, where is supply going to come from?
I would question the initial preface or the caveat there. I think we will see more monetizations. I'm not Pollyanna saying it's just going to all come over the transom now and be huge, but we'll continue to see that trend continue, in my opinion. And the rest of it, I think you'll see a lot coming from private equity to the REIT community as fund timelines kind of go away.
Can I add on to that just really quickly? If the health systems, if changes are taking place with their financials, are they still are products still desirable? If they're forced to want to monetize, are you going to have your institutional investors and everyone still interested, and you guys too? Yeah,
well, this is the I part of the REIT. We're in the real estate business, but then you have to get real clear on the investment piece and who your partners are.
an important part of the supply is the development pipeline. We forget, we haven't mentioned that, but we have some very nice statistics showing a growing area for that. Mark, you participate very actively on the development side. So some of the largest portfolios of medical office buildings sold over the last 10 years have been coming out of developers, and there have been, $150, $200 million scale portfolios from developers, and one-off deals. There are non-traditional healthcare developers, so it could be a commercial office developer who does a single outpatient building for a hospital because that hospital wants to be in that location. So that's the holy grail for people like Mark and Dan, because they're great product, but they're a little bit off the beaten path in terms of who the owner or developer is. So I think I am optimistic about supply coming in from that segment of the sector.
We've seen good growth in our kind of takeout side of the operation, and I think that's going to continue.
I would just add, there's still supply coming there. It's just that there's so much more capital right now at this point in time. So there's still, obviously, as many slides show, there's still a lot of transactions being done, and certainly some of them are excellent core transactions that a lot of the REITs are very interested in. It's just right now that there's a lot more people trying to get into the space, and so at some point they'll find that equilibrium.
There's an interesting category, which I didn't attend it, but I think they were touching on it in the construction panel, where there are some major urban mixed retail office, medical office properties. So it might not be something that Doc REIT invests in, but the investment managers have a unique ability, either in their funds or through separate accounts, to buy these hybrid properties where they're very substantial medical office components, could be multiple 100,000 feet. And it's not going to be everyone's cup of tea, but it helps to sate that appetite for healthcare. So I would envision a lot more of that product. We've seen it downtown Chicago, Nashville. It's out there, and it will become more of a factor. Any other questions? Great. Well, thank you for your time. And
Thank you.
appreciate you attending.